Many real estate investors consider selling a property but are unsure how to do so without triggering a large tax bill. See, when a property has appreciated over time, the sale can result in capital gains taxes and something called depreciation recapture. For some, that tax impact may be enough to delay or avoid selling altogether. But there is a way to sell investment property and defer those taxes under Tax Code Section 1031. In this episode of Getting Real, we're going to walk through a real case study where an investor used a 1031 exchange to sell a rental property and reinvest without giving up the income or taking an immediate tax hit. Now, don't forget to subscribe and hit the little bell icon so that we can alert you to all of our upcoming video content. Let's get started. Let's introduce Robert, a retired investor based in Naples, Florida. For years, Robert managed a single-family rental property that generated reliable and stable income. But after retirement, the hands-on responsibilities of being a landlord no longer aligned with his personal and professional goals. He wanted to preserve his income stream, but eliminate the stress of the day-to-day property oversight. Now, at this time, selling the property outright would have triggered a substantial tax liability due to both the long-term appreciation and prior depreciation deductions. See, earlier I mentioned something called capital gains and recapture depreciation. So let me explain quickly. Let's say, for example, an investor like Robert, for example here, owns a single-family rental property, and over the course of, let's say, 15 years, they had accumulated depreciation of, let's just say, $20,000. Well, what happens is even though they got all of those depreciation deductions, that $20,000 in depreciation will actually become recaptured upon the sale of the property, and they'll have to pay taxes on that amount. In addition to that, they have the capital gains based on the appreciation of the property. So that could be substantial for an individual investor like Robert who's selling a property. But you're going to learn in just a moment, Robert can utilize what's called a 1031 exchange. Robert actually learned about this technique through his CPA, and now he had a potential path forward. So here's how it worked. He sold the Naples rental property for $330,000. Because there was no debt on the property, he had the full proceeds available to reinvest. Now, after reviewing several options with his securities representatives, Robert selected a diversified portfolio of Delaware Statutory Trust, short you'll hear DSTs, which included commercial properties in Arden, North Carolina and Richmond, Virginia. His reinvestment totaled just over $326,000, aligning closely with the proceeds from the sale. So in other words, what he did is he took a single-family rental property that he had to oversee and manage. He sold the property and deferred all of the gains into real estate that allowed him to generate passive income without having to do all of the work. So what exactly is a 1031 exchange, and how does it work for investors like Robert? Well, let's take a look. A 1031 exchange, named after Section 1031 of the tax code, lets investors defer capital gains tax when selling investment property as long as they reinvest the proceeds into another like-kind property, or it could potentially be multiple properties. Now, it has a few rules that you need to follow. Number one, both the sold and purchased properties must be held for investment or business use. So what this means is no personal residences will qualify. Number two, the replacement property must be like-kind, meaning any real estate held for investment purposes. All right, number three, investors have 45 days to identify the replacement property and then 180 days to complete the exchange. Now, the 45 days for the replacement property, that could be multiple properties identified, then you select one or multiple properties and then close within 180 days. Next, the sale proceeds must be held by a qualified intermediary, not the investor. So the funds cannot flow through your hands, and this is why it's really critical that you're working with a qualified intermediary That's a third party that's going to hold the proceeds from the sale and help you complete the 1031 exchange according to the IRS guidelines. Now, equity 1031 exchange can serve as a qualified intermediary and support you through the entire process. So even before you sell a property, you want to interact with a qualified intermediary like equity 1031 exchange to make sure all the T's are crossed and I's are dotted. That way you can preserve your capital for reinvestment, and it can be a powerful tax strategy for a long-term real estate investor just like Robert. Now, why do people consider a 1031 exchange? There are a few potential reasons. Number one, you're selling a highly appreciated property and you want to defer taxes. If your property has gained significant value over time, selling it could trigger capital gains taxes and, as we discussed earlier, depreciation recapture. A 1031 exchange can allow you to defer those taxes and keep more of your equity working for you. Number two, you're reinvesting into other income-producing property instead of cashing out and taking the tax hit. You can use a 1031 exchange in this case to move into another investment property, potentially one that generates stronger cash flow and that fits your current goals better and requires less property management. Number three, you're consolidating or diversifying your portfolio. Maybe you want to sell multiple properties and exchange into one larger asset, or sell one and reinvest into several. A 1031 exchange gives you the flexibility, control to balance your portfolio without triggering immediate taxes. In some cases, investors completing a 1031 exchange choose to reinvest into a more passive option, unlike a single-family rental property like Robert having to manage on his own. Instead, transition into a Delaware Statutory Trust, DST for short. So let's take a moment to explain what that is and why Robert went this route rather than buying another investment property. A Delaware Statutory Trust, DST, lets multiple investors own shares in a large-scale real estate transaction that is managed by an investment sponsor, and now this investor has passive income rather than managing properties on their own. Now, this worked for Robert because DSTs offer a way to complete a 1031 exchange while stepping away from the day-to-day responsibilities of property ownership. No tenants to manage, no maintenance calls, just passive income from real estate held for investment. Through a DST, Robert was able to, number one, fully defer taxes on the sale of his investment property. Number two, transition out of active property management. Number three, diversify into professionally managed real estate assets. Number four, maintain monthly income to support his retirement. If you're considering selling an investment property, but you're concerned about capital gains tax, a 1031 exchange could potentially defer those taxes and keep more of your money working for you, just like in Robert's case. If you'd like to explore whether a 1031 exchange could potentially be a good fit for you or not, visit getequity1031.com or check out the link in our description to set up a call. We'll walk you through the process, answer your questions, and help you take the next step with confidence. Thanks for watching. If you enjoyed this video, don't forget to hit the subscribe button right here so you never miss out on new content. And if you're ready to dive deeper, check out our other videos and resources right here.